Coming up today, is the stock market sell-off over? Could we actually get a Fed rate hike this year? A look at seasonality, Netflix earnings, Tesla woes continue, Trump stock bounces 26%, the latest IPO to hit the market, and your chocolate just got a whole lot more expensive. Hey, what's up guys? Welcome back to your favorite financial YouTube channel. My name's Jared and I'm going to get you all up to date on everything important happening in financial markets today and share a few swing trade and investment ideas of mine as well. So stick with me today. I've got a great show for you, and if you haven't already, hit that subscribe button and these videos will show up on your YouTube home screen every day you log in. And just to start off with a bit of market color, we are still uptrending across the board in volatility, bond yields, gold, the dollar, and inflation expectations, with all the major US indices and sectors bar energy underneath the medium-term 50-day moving average, with a little bit of a tick up the front in staples and utilities on a bit of a defensive rotation in the market, along with financials. And we've even got oil now a little weak up the front and in the short term, more of which I'll get into later. And we actually had the S&P 500 stall out just above 5,000 here today. Got one of my reversal signals firing off, and just going down to a 15-minute chart, you can see the market late in the session got within a point of a half of hitting that big psychological 5,000 level. We just finished a bit above it, so we'll probably dip below it tomorrow. However, we'll be looking for this big psychological level to hold and potentially get a little bit of a bounce here. And one stock in particular I'm looking for a bit of a swing trade bounce is JP Morgan. Just got my 5th consecutive reversal signal. That's the most we'll get in a row. DSI is oversold. The stock still holding on to its overall momentum trend that it's been in since late October. And so this is a bit of a classic buy the dip setup in JP Morgan. Looking for a reversion to the mean, to the 50-day VWAP here in the yellow line, and with a stop at the bottom of the buy-sell band, risking about 7.7 points to make about 9.2 points, giving us a risk to ratio of 1.2. And so why am I off JP Morgan for a bit of a swing trade here? His last earnings weren't that bad. Did come in above forecast, even though Jamie Dimon did come in with a bit of a sobering reality. I think the fall's more than accounted for that. We've already had our 10% pullback in JP Morgan, unlike the S&P 500. Which hasn't quite done a 5% pullback yet. Also, seasonality is in our favor, 10-bar forecast at 2.4%. And just going through some of the other financials, Charles Schwab holding up there good above the 50-day. Just got a momentum upward thrust on the third largest bank, Wells Fargo, looking pretty technically good after its earnings. Bank of America a little softer, same with Citigroup. However, JP Morgan is the most oversold of them all. So this is just another trade setup. I'd put the probability of a mean reversion here about 60%. Doesn't mean it's going to work out every single time. However, I like the risk reward. On the buy the dip swing trade on JP Morgan here, playing it back to the 50-day VWAP, even if that would turn down a little bit over the next couple of days. So I'm looking for the S&P to get a little bit of a bounce off 5,000 here. Maybe take us back up 5,100, 5,150, where we may resume the downtrend with the next point of support, looking around 49.20, where we turned a few times back in February. And if we cut through that, then I'll be looking for support around 47.50, which is a 50% retracement off the October lows. Quite often in markets, we'll get the 50% pullback in multi-month moves. However, that doesn't mean we can't clean cut through S&P 5,000. Tomorrow or going into next week, got a lot of people out there saying don't buy this dip in stocks. It's not over. And that's the usually bullish Tom Lee from Fundstrat. He said because volatility is rising, that's going to bring near-term pressure to stocks. And you guys know I've been talking about that for the last week as well. With the rise in the VIX, seems to have found footing on higher ground here. We've been trading at a 12-14 handle for months going back to late November. However, with the breakout and war between Iran and Israel, I'd say the VIX is going to hold at least above 14, potentially 15 for a little while now. And since a large part of the market are vol target funds, when volatility gets higher, they have to reduce exposure to equities. So that should help keep pressure on stocks here for a little while. Even if we don't continue falling, we should at least consolidate for maybe another month or so. And we've got some other signals to back that up as well, including the century-old Dow theory. And that basically says when the Dow Jones Transports or Dow Jones Industrials, when either one of those indices breaks out to a new 52-week high, the other one should follow in short order, and that hasn't been the case lately. We've had industrials break out, however, transports didn't confirm. So Dow theory is suggesting this sell-off has more room to run. And you got to remember this whole stock market rally from those October lows was based on J. Powell pivoting from hawkish to dovish, and then straight away the market started pricing in 5-6 rate cuts this year to start the year off. We can see that in this timeline of headlines from Goldman's in January, expecting 5 cuts. In March, they came out and spec'd 3, and now a week ago, they're expecting 2. However, now some are even talking up the possibility of a Fed rate hike, given the strong jobs market, consumer spending, retail sales, government spending. However, I think it's more likely the Fed will probably remain on hold, at least through to September, just as we heard from a Fed President, Kashkari, say that today. I don't think they'll be cutting anytime soon. They're really waiting to see if these recent upticks in inflation are going to hold or they're just a bit of a blip in the road. However, like the rest of us, I think the Fed's watching commodities, oil, what's going on in the Middle East as major inputs into what inflation's going to do around the corner. Adding pressure to the stock market is pension funds, selling hundreds of billions of dollars worth of stocks, along with other large investors who can easily get a higher yield now. We've had bond yields moving up materially these last couple of months. And when these large investors are looking at what's going on in the Middle East, long-term valuations in stocks and earnings yields aren't that great. The appeal of a risk-free 5% and how many funds rebalance according to the yield differential between stocks and bonds, along with the view that the Fed's going to cut rates, which is a tailwind for bond prices, is keeping assets and fixed income investments relatively high. And my stock bond allocation indicator is suggesting the same thing. It's recommending a 60-40 allocation, 60% to bonds, 40% to stocks. The highest allocation to bonds ever since 2007, and that's based on relative valuation between those two asset classes. And after we heard New York Fed President John Williams actually hint at the possibility of a rate hike, that gave a bit of support to US government bonds across the yield curve. There's the 2-year technically forming a bull flag here, just below 5%. Might get a clean break through that tomorrow or the next day. And the 10-year sitting pretty as well, above 460. And so these high bond yields also helping to keep pressure on the stock market here. And as JP Morgan suggests, the stars may be aligning for a repeat of last August stock sell-off, with they too pointing to what's happening in the bond market as calls for stocks to keep falling a little bit here. And just looking at some historical data of drawdowns we get in election years, which we're currently in. The average drawdown in S&P is 13%. Same with the Dow. We don't have as much data for the NASDAQ. However, from the early 70s when the NASDAQ was first created, the average election year drawdown's been 21%. The last one in the S&P was in 2020. That was 33%. However, that was right in the midst of COVID, so that obviously skewed the numbers a bit. Prior to that, 2016, we got 9.3% drawdown. 2012, almost 10%. And so like I said, if we get a 10% drawdown, that'll take us to about 4750 on the S&P 500. So that could be a target for the next month or two, especially looking at seasonality at this point of time. From mid-April through late May, looking at the average performance of the S&P 500 from 1950 in election years, typically a period where we have a bit of softness or sideways action at least, then going into a summer rally before pulling back in the usually weak months of September, October, where we normally find a bottom around that time and rally towards Christmas. So 2 weeks ago, it was CPI data. Last week, it was geopolitics. Now this week, the stock market's turning its attention to getting into the thick Q1 earnings season. We just heard from large tech company Netflix posting strong numbers, but they gave a weak revenue and they're stopping reporting how many subscribers they're growing. Even though they did a good first quarter, their crackdown on password sharing is paying off. They added 9.33 million net new subscribers, well ahead of Wall Street consensus of 5.1, and said they see 2024 revenue growth of 13 to 15%. So all in all, a pretty good quarter. However, more important is the market's reaction. So we're a little soft coming into earnings here in the regular sessions, and just going down to a 15-minute chart after hours, stock's actually off 4.5%. So the market didn't like that, or potentially is just a liquidity event for big funds to get out a little bit. We also got earnings from Las Vegas Sands today, and the market is selling them off as well, even though they beat, posting first quarter earnings of 75 cents, well ahead of Wall Street's call for 62 cents. Beat a little bit on revenue as well. However, they're forecasting a bit of disruptions in the important Chinese market of Macau, which led JP Morgan and a few other analysts to downgrade the stock, and that's why it fell big today in the regular session, down 8.6% on volume. Just around the corner, we've got the rest of mega cap tech reporting over the next week and two, with Bank of America saying Microsoft, who's going to report this time next week, has 17% upside potential, and upcoming earnings will show strong AI-driven growth, of which I think the market has been expecting for some time. However, the stock is pulling back a bit from all-time highs here, down 1.8% today, along with the second biggest stock in the market, Apple, doing a quick U-turn. It's only a week ago had a strong pop above the 50-day on news of their latest generation AI chips. However, we're just taking out multi-month lows today. Looks like the downtrend in Apple is still intact. Just sticking with mega cap tech, there's a look at NVDA, lower highs, lower lows. Amazon just closing below its 50-day. Meta sitting there, and Google, the best performer of them all, just a few points below all-time highs. What's doing the worst out of all of them is Tesla, with Wall Street really turning its back on the company now, not really liking its pivot from a low-cost Model 2 towards robo-taxis. Had just about every big bank and research house come out and downgrade the stock, with Deutsche Bank just downgrading today from buy to hold and dramatically lowering their price target to $123 a share, believing their planned Model 2 will be pushed out to late 25, and that their previous buy rating was predicated on the next gen vehicle priced at $25,000 coming late next year, which would allow the company to re-accelerate volume, margins, and free cash flow, and potentially come to dominate the Western electric vehicle market. However, it's not just that. There's also a few internal problems. Tesla's been laying off staff, of which we just heard another round today, and there's been a few other key executive departures as well, on top of reignited controversy on Elon Musk's pay package. After it was just reversed in a Delaware court, Tesla then relocated their headquarters to Texas, and now it's currently going through the rounds for shareholder approval. It is huge, $56 billion. He did meet the targets that were initially set as part of that package. However, Delaware court ruled conflicts of interest because the board members were considered to be too close to more friends. Although I would say that is pretty much the case with every company board out there. That being said, it is a huge pay package, $50 billion, considering now the company's market cap is under $500 billion. But I'd say more importantly is what's happening with China and their huge surge in manufacturing subsidiaries handed out from their government, flooding global markets with cheap steel, electric vehicles, in which they also benefit from their artificially fixed currency rate, as the Chinese yuan does not trade on a free market like all of our currencies do. They set their rate towards the US dollar. It gives them an unfair advantage. And the Americans and Europeans are pushing back on the Chinese and their artificially priced low exports. It's potentially going to reignite trade wars and tariffs to address that issue. That's why we've seen the average price of a used Tesla car fall a lot in the last year, get cut in half, and along with that the stock price falling another 3.5% today, losing the 150 handle with a market cap now of $477 billion. And I still think its valuation is questionable given the short-term risks in Cybertruck, robotaxi, cheap Chinese EVs, staff leaving, Elon's pay package, etc. I'd say it represents good value again if we got down to the low 100s. And even then, its valuation could still be up for debate. Moving on to one of the hottest stocks in the market, Trump Media. Having a really good technical bounce today, and the company that owns Truth Social is showing stockholders how to block short sellers. And so they know they are a target for short sellers. However, short sellers can only short it if there's shares available to borrow, and you as a holder of shares have to allow that. I trade with Interactive Brokers, and you can sign up for their program, which allows your shares to be lent out, and you'll receive a small yield for that. And so they're advising shareholders to hold their DJT shares in a cash account at a brokerage firm instead of a margin account, and opt out of any securities lending programs. In other words, crush the supply of stock that short sellers can borrow to sell the stock. And latest data shows there's only 10,000 shares available to borrow with an annualized fee of 215%. So that is huge. In other words, it's really hard to short here. And we just got a beautiful technical bounce. After getting some reversal signals, oversold in the DSI, turned up on volume here, finished at the highs, up almost 26% today. After this has been a hugely volatile stock. Less than a month ago, we're almost at $80 a share. Yesterday, we're down at $22. So this is likely to remain highly volatile, and you could kind of think of it as a proxy on Trump winning the election in November. Because if he does, this stock could shoot up, but if he doesn't, this stock could crash. So it's definitely going to be interesting to watch over the next couple of months, and is really well traded by the market as well. 17.8 million shares today at $33. It's coming in about $500 million worth of trading volume for a $4.5 billion market cap. That is really high turnover. And as markets have been recently hitting new all-time highs, we've seen private companies rush to turn into public companies and come onto the market with IPOs. And we just saw that today with Walmart-backed IBIT having a good launch, raising over $500 million. And they're a tech marketing firm. With the IPO priced at $88, shares got up to $116 today. And they're basically an advertising platform for consumer brands, promotions, and provides cashback opportunities for shoppers. Definitely not a new concept, but they are backed by some big companies like Walmart. And there's a look at their website homepage, offering a mobile app allowing consumers to earn cash back in store and online with a whole bunch of big retailers as well. And there's its first ever daily candle, trading 4 million shares, closing at $103. Looking at the other latest IPOs is AI stock Astera Labs, still holding ground above when it came into the market. However, Reddit lost a little bit of its footing, trying to find support here today. Moving on to commodities, we've got oil fallen again here today, even though we just got news that the US is going to reinstate sanctions on Venezuela after not liking what's going on with their elections, and the world's still waiting to see what Israel's response is going to be to last weekend's attack from Iran. However, since supplies from the Middle East aren't really disrupted at the moment, got a bit of an uptick back in supply back in the States. I'd say why the market's really pulling back is the White House might be trying to goose it a bit, that they're carefully monitoring gasoline prices to make sure they're affordable as we lead up to the presidential election in early November. Joe Biden and his team really want to keep the price of gas down, and so they're kind of hinting to the market that they might release more oil from the Strategic Petroleum Reserve, SPR, and that could have a big material effect on the oil market like it did in early 2022 when they released a whole bunch in response to Russia's invasion of Ukraine. And so that's a real strong signal for the market to lean against, and hence why, like crude oil futures, lost its 50-day today, actually getting down to $81 a barrel, and we may even continue to cut down through $80, potentially find support around the mid-70s. However, I'd be surprised if we did go below the mid-70s, just like the VIX as well. I think what's happening in the Middle East should keep a bit of a floor in there, at least for a little while, until we see how Israel responds to Iran. So your gas is going to get a little bit cheaper soon. I've got bad news for all you chocolate lovers out there, including myself. We're going to have to pay up for the good stuff. Believe it or not, cocoa just broke out again. CTAs, trend followers, certainly happy with this, but not us chocolate lovers. Price of cocoa now hitting over $10,700 a tonne, with supply stress behind the price gains, as large producer Nigeria prepares for more flooding and continued poor weather and crop disease. Coming out of other producer states like the Ivory Coast and Ghana, now we're looking at massive flooding in Nigeria, with the at-risk zone actually accounting for 94% of the nation's cocoa production, and output losses expected to be colossal. Production is forecast to fall behind demand by 374,000 metric tons this season. That's a huge demand-supply imbalance, and that's what really drives commodity markets. And the price of chocolate's already been moving up for a while. US stores charged 11.6% more on these products than in 2022. A lot of inflation in chocolate. And actually last print just got above $11,000 a ton. This is one of the best uptrends you'll ever see in the market. Absolute parabolic rip. And like I said, this is the biggest winner for trend followers at the moment, and they must be certainly happy with what they're seeing here today. Moving on to crypto, we've got JP Morgan saying Bitcoin's latest sell-off is a good entry point for investors ahead of the halving, which is set to happen tomorrow or Saturday, in which the daily supply of new mined Bitcoins gets cut in half, and that's typically preceded bull runs in the crypto asset. The last 3 times this has happened. This is the 4th ever halving. And whilst it's certainly possible, it seems a little too easy. And most of the time, these repeatable patterns don't always work just like clockwork, as the market doesn't always make it easy for us traders and investors. And so technically speaking, it's just looking to hold support here above $60,000 a coin, and looks to have been consolidating for the last couple of months, with Ethereum a little bit weaker here. And we're still waiting to see whether the SEC is going to approve Ethereum ETFs. We'll get a bit more color on that in the coming weeks. The growth stock that I've just added to my watch list today, I think is becoming fairly valued, is COVID favorite Zoom Video, with an analyst from Rosenblatt Securities increasing her rating on the stock to a buy with a target price of $75, with her buy rating reflecting a new channel strategy with partnerships with Avia, Amazon Web Services and others to help reach new customers for the company's Zoom Phone and contact center products. She also cited a healthy balance sheet, and the company's recently announced $1.5 billion stock repurchase program. Us as investors like that, gives us a good tailwind as it decreases the amount of supply of shares on the market. She also cited good momentum in their new product Zoom Phone and getting into AI integration, and they do have a pretty strong brand, and I think technically speaking a bit oversold here in the short term. On the monthly chart, I have to actually go to logarithmic to see it because it's come off that much from COVID highs when it went absolutely crazy. Everyone's locked at home, having to do everything over Zoom. The market peaked out, stage 3 distribution, stage 4 decline. And I'd say we could be moving our way through a stage 1 accumulation right at the bottom of the range here, with the bottom being at $58.80, just currently under $60 a share. And with recent annual revenues, $4.5 billion for a growth tech stock, it's not too bad. Market cap $18.4 billion. My stock fair value doesn't mind it either. It's got fair value around $69 a share. Slightly negative shareholder yield, reasonable business quality score, along with a really good recent earnings beat as well. So I've got my eye on this one for potential medium long-term play, as I don't think Zoom's going away anytime soon, and like that analyst pointed out, got some promising products that they're currently expanding into new markets. And just looking at what major shareholders are doing in the stock, pretty much all of them are accumulating, except for ARK Investment, Kathy Wood, who's offloading. However, that's a really good contrarian indicator, since she consistently underperforms the market in the long term. That makes me happy to take the other side, and instead, like these other major shareholders, they've been increasing their positions on this stock price weakness. Moving on to economic data, we really didn't get much out this week. Jobless claims today came in a little bit better than expected, nothing too much of noteworthy there. Existing home sales came off a little worse than expected. Had a few Fed speakers in which they all came out pretty much saying the same thing, going to stay on hold for longer. Tomorrow we'll get retail sales, United Kingdom, and just one more Fed speaker to finish the week out. And Fed Fund futures still pricing in a cut in September. However, the trend this year has just been one of continually pushing it out and pushing it out. Fear ingredient index still sitting in the middle of the fear zone. Can be a spot where we might get a little bit of a bounce. However, normally at the end of a big correction, we normally find that in the extreme fear zone. Not much corporate insider trading. We are currently in a corporate buyback blackout period where most companies are not buying back their own stock. However, that doesn't apply to all insiders either. Getting back into the charts, it was a little bit more of a defensive rotation today. The winning sector utilities, losing sector technology and discretionary. With consumer discretionary, typically a growth sector, now underneath its long-term 200-day moving average. It's not a good sign for risk on. And we just had the Magnificent 7 as a group put in its 4th consecutive day below the 50-day VWAP, something that hasn't happened since October last year. And we've got the Russell 2000 looking a little oversold here as well, with actually a bit of a pickup in short-term breadth, 10% of stocks above the 20-day average, looking like it's turning here a bit, and a continued pullback in the VIX. And high-yield bonds trying to find their footing a little bit here as well. The dollar index still consolidating just below 106. Another good day for agricultural commodities. Momentum upward thrust, up 2% to new multi-month highs. Probably one of the strongest trends in the market right now, along with cocoa and a bit of a pullback. Dark cloud cover candle there in coffee futures. Bit of a bounce back in Chinese securities and clean energy. And if you're a long-term believer like me, these low prices make for good DCA, dollar cost averaging opportunities to add to long-term positions as we continually buy the dip on the way down. Whilst this market offers us some attractive long-term valuations, this ETF PBW has a dividend yield just below 4%. There's a look at international stock indices, all having a bit of a pullback, except for China holding onto its 50-day. We've got the Nikkei and the Aussie 200, along with S&P 500, all having 4-5% pullbacks here, and continued downward price action in the spread of consumer discretionary versus staples, showing the market is having a bit of a defensive rotation in the spread between commodities and stocks, looking to hold this strong uptrend, along with inflation expectations and semis continuing to pull back, along with the tech sector at large. There's a look at AMARC, just kind of trading a bit flat there today. Looks like it's over for Abercrombie and Fitch. Their beautiful uptrend had for over a year seems to be lost now. Another uptick for the aerospace and defense contractors, and there's a bit of that defensive move into stocks like Pepsi, having a good day. And there's JP Morgan, like I said, looking for a little bounce here as a potential mean reversion swing trade. See if it can hold these 176 levels. Of course, that depends a lot on what the market is going to do in the next couple of days as well. All right, guys, there we are for today. Looks like a bit of an orderly algorithmic selling, just sliding lower here. We'll see whether 5,000 can hold tomorrow. May dip below that. We'll see if we can close above it to finish the week out. We can have a little bit of a retracement in this downtrend before potentially turning lower again. Given what's happening in volatility, bond markets, and a clear risk-off rotation, on top of waiting for Israel's response to Iran. Seasonal weakness and other technicals that suggest stock market may see a bit of weakness or consolidation for the next month or two. Thanks very much for tuning in to the Click Capital Daily Market Review. I look forward to seeing you again tomorrow night. Cheers.